All right, let's get right into it. Today we're talking about something huge, something that could be the difference between good returns and great returns. It's this idea of a valuation gap. Are you valuing stocks like an amateur or like a pro? Believe me, the difference is massive, and it might be the reason you're leaving money on the table. We're going to break down exactly what the pros are seeing that most of us, well, we just miss.
So, let me just ask you straight up. Are you investing blind? I know, it sounds a little dramatic, right? But think about it. If you're not using the right valuation tools, that's kind of what's happening. You might be picking stocks based on a headline you saw or a really simple metric, and you have no idea about the incredible opportunities or the big risks that are hiding just under the surface.
And look, if this sounds familiar, you are definitely not alone. The number is just staggering. Something like 95% of individual investors really struggle with this kind of in-depth valuation. Most people just never get past the absolute basics. And what does that mean? It means the vast majority of us are playing the game with a huge disadvantage. This isn't some rare issue. It's basically the default setting for most investors.
So why does this gap even exist? Well, it's because there are really two totally different worlds when it comes to valuation. It's like two parallel universes. In one, you've got the amateur approach, the one most of us start out with. And in the other, you've got this systematic, data-driven world of the professional. And the difference between them, it's like night and day.
I mean, just look at this. The contrast is just wow. The amateur says something super simple, right? Hey, the PE is low, this stock must be cheap. Easy. But the professional? They're speaking a completely different language. They're talking about 10-year DCF models, multiple scenarios, return on invested capital decay, all leading to an intrinsic value with a margin of safety. See the difference? They aren't just reacting to one number. They're building a whole fortress of analysis around their decision. They're literally stress testing the future.
And you might be thinking, okay, that's a lot of work. But this isn't just some academic thing they do for fun. No, this is exactly how the big institutional investors find those incredible opportunities. We're talking about those hidden gems, the companies trading at a 50, 60, even 70% discount to their real value. They see this massive potential where everyone else sees nothing, and it's all because their analysis goes that much deeper.
Okay, so what does this deeper analysis actually look like? What's in the toolbox? What are the pros using that the rest of us aren't? Let's peel back the curtain and take a look inside the professional's arsenal. And spoiler alert, it's not magic. It's all about having a methodical, repeatable process.
So here's the kind of stuff they're using. Their whole toolkit is built for one thing: depth. They're not just making simple projections. Nope. They're using things like multi-stage DCF models, which basically account for a company changing over time. High growth now, maybe slower, and more mature later. If it's a big, complicated company, they'll do a sum of the parts analysis, valuing each little piece on its own. And this next part is absolutely crucial: scenario analysis. They're not just looking for one single right answer. They're figuring out what happens in a great scenario, a terrible one, and a normal one. The goal isn't to find a magic number, it's to understand all the possibilities.
Now, the big one you hear about all the time is the DCF model. That stands for discounted cash flow. So what is it really? In simple terms, it's just a way to figure out what a company is worth today based on all the money it's expected to make in the future. See, it's not about what happened last year, it's all about looking forward, and that's what makes it so incredibly powerful.
Okay, that's the theory. But does this stuff actually work in the real world? Let's get into a case study, because this one is a perfect example of how this pro-level approach can uncover an absolute monster of a winner that almost everyone else just walked right past.
Let's talk about a company called Asian Paints. Go back to 2023, the stock is trading around 3,200 rupees. And the general feeling on the street, the common view, nah, it's too expensive. You look at the simple surface-level numbers, and yeah, it looked like it was fully priced. Not much juice left to squeeze, right?
But a professional analysis told a completely different story. Someone who did the hard work, who built a detailed DCF model, they saw something else entirely. Their numbers showed that the stock wasn't expensive at all. In fact, it was trading at a massive 40% discount to what it was actually worth. That professional toolkit saw a huge opportunity that the rest of the market was completely blind to.
So what happened? Well, you can probably guess. The market eventually woke up and caught up to reality. And as the company's real value started to shine through, the stock took off. We're talking an incredible 180% gain. Now let's be clear, that wasn't luck. That was a direct result of using a better valuation system to spot an opportunity that was hiding in plain sight.
Okay, so that's the amazing upside. But let's flip it around. What's the downside? What's the real tangible cost of, well, of guessing, of just relying on those simple metrics? For most of us, the risks are actually pretty significant. The cost is real, and you can feel it in your portfolio. You end up overpaying for those super popular growth stocks that everyone's talking about, but that aren't actually creating real value. You completely miss the hidden gems that the big institutions are quietly buying up. And maybe worst of all, when you don't have a solid data-backed plan, you're way more likely to make panicked, emotional decisions. Put it all together, and it could mean leaving, say, 5 to 10% in returns on the table every single year.
All right, so how do we fix this? How do you bridge that gap? How do you get from the amateur's world into the professionals? It all comes down to unlocking your own professional edge. And the best part, it's probably way more accessible than you think.
And really, if you remember one thing from all this, let it be this. It is not about being smarter. It's about having a better system. That's it. The pros aren't geniuses. They just rely on methodical frameworks, not gut feelings. And the really good news is that a system is something that anyone can learn. Anyone can adopt it.
So that leaves us with one last really important question that I want you to think about. Take a hard look at your own investments. Is your portfolio built on real, solid analysis, or is it built on assumption? Just being honest with yourself about that answer, well, that's the first step to closing that valuation gap for good.